Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. And for the first time in a couple of weeks, we have a full Investment Friday episode for you. Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies, is back with us today. Brad, how are you doing? You weren't feeling good last week. So how are you doing?
No, I'm doing great.
Awesome.
I'm doing great. So for those that didn't know, I did some international travel, and when I returned home, evidently I brought some things with me that aren't very typical. And so myself and a couple of medical professionals got that all sorted out in a little bit of time. And now I'm great, doing wonderful. Thanks for asking.
Good. We were just talking about international travel, and that reminded me that my husband and I went to New Zealand in 2018, had a fabulous time, absolutely amazing. On the plane ride back, the woman next to me was coughing super weird while we were eating. And I was like, oh my God, are you kidding me right now with this? And sure enough, when we got back and got settled, I had like 2 weeks worth of, I don't know what it was, but it was like, I picked up something likely on the plane coming back. So I've
It,
heard that with international travel in general.
Yeah, what's crazy is what I noticed both times, both my going out trip and my returning trip, is on the fuselage of the plane before you get on, it actually has a sign there that says the air is purified to 99.9% pure, that it is filtered throughout the fuselage, and it's filtered, and the germs are extracted out of the air. So I thought that was interesting that I actually saw a sign on the fuselage. So that just goes to tell you that sometimes you shouldn't listen to all the signs because they're wrong. Because I definitely got sick. They think it was while I was at my destination, but still, it's I can blame it on the plane flight too.
Yeah, you never know. Well, I'm glad you're feeling better and you're back home safe and sound. And we have had quite a couple of weeks in the markets. And so, yeah, some really interesting things happening. So tell us what have we missed? What's going on?
Well, I think it's interesting that people are getting acclimated to the condition where the Federal Reserve may not be cutting interest rates nearly as much as people had anticipated, particularly at the beginning of the year. They thought, hey, we're going to get 6, maybe 7 interest rate cuts. It looks like 2 to 3 at most right now, starting possibly June, July timeframe. Now, the last time we spoke, we talked a little bit about how I was always in the camp of mid-year, maybe 2 or 3, on the outset 4 interest rate cuts. Here's the interesting notion is the Fed's not in a rush to cut rates. And the reason why is because nothing's blown up. No area of the economy or of the equity market is showing massive distress. Okay. It's still functioning. Everybody's trading. Everything's going well. Certain parts of the equity markets are doing extremely well. Certain parts are kind of languishing, but they're not falling off a cliff. They're just kind of hanging out at their current valuations. And so it's an interesting dynamic because the Fed's like, yeah, we don't really need to cut interest rates. The one caveat to that is the longer interest rates are high, the worse it is for office commercial real estate, with high vacancy rates, with a lot of loans coming due in the next 2 years where they have to refinance those commercial mortgages. That's a little bit of a problem child, and that may force them to do something a little earlier than they otherwise would have. But at this point, they're not in a rush. GDP growth, really, really good. Somewhere between 0 and 2% for the first half of this year. And that is far stronger than what a lot of people had anticipated. They thought we were going to go into a slight recession here in the first half of this year. I was in that camp a little bit, bouncing around that 0% GDP growth. But it looks like we're actually going to just go into maybe a slow growth mode. And then the second half of the year, if they start to lower interest rates, really start to reaccelerate GDP growth towards the third, fourth quarter of this year. So yeah, things are going well, but people have to get used to the fact that we might have higher interest rates for longer than they anticipated.
So one thing you mentioned commercial real estate, and office real estate in particular, right? One thing that I've been kind of noticing, and looking at social media and talking to realtors and different things like that, the is like the what do I want to say? The disparity between how housing prices and interest rates. I don't mean the disparity necessarily. It's maybe not the right way to say that, but that because interest rates are remaining fairly high for mortgages, people are having a much harder time literally qualifying for the loan size, that otherwise, if rates were at 4% or 3%, they could qualify for a loan based on their income. But with the interest rates being closer to 6.5, 7+%, they're actually like priced out of different markets, right? So thinking about some of the higher price markets like even Washington, Seattle area, Portland, Oregon, anywhere, in New York or California, Arizona, um, really high housing prices right now. And just wondering like where that tipping point will be, because if someone is making, three or $400,000 based on their, the ratios that we have to keep in order to qualify for a mortgage, they based on the interest rates that are available right now, like they actually can't qualify for homes. Say if you're in Arizona, that would be available. When the average home price is 450, 500, 600,000, you actually have to have pretty high income to
Yeah.
qualify for that. So, yeah, I've just been that particular stretch point, has caught my eye recently, and I wonder if there's anything that will shift in either the housing market with housing prices, which I'm not seeing any evidence that housing prices are gonna come down, or slow down in the increase. But with the interest rates where they are, it's making it difficult for people to qualify.
Yeah, it's interesting. It's an interesting divergence from over the past couple of years as interest rates have come up. Mortgage rates have gone from basically 2.5 to 7, a little over 7 at some points. Um, that's a big increase.
Mhm.
And then combine that with the valuation increase that happened over the past few years, that's a big deal. It's a big deal, and it is hampering the existing home market. It's one of the reasons that in 22 and 23, 2022 and 2023, new home sales were the majority of the home sales. Because basically builders could buy down your rate, then you could qualify for more home, and they recoup their profits through the sale of the home as well as the mortgage. Um, what's interesting is actually today that was announced was existing home sales have started to come back up.
Mm.
So existing home sales over the past couple of years have been really, really suppressed because of those higher yields. I mean, who wants to sell their existing home that has a 4% mortgage, go buy another home that has a 7% mortgage for the value that's higher? It's very difficult to make that math work and to desire to do that because moving homes is a big deal. It's very expensive. And so you have to make sure you're getting a good deal. I would say as existing homes start to trade, okay, as they start to, return to somewhat normalcy, you'll see a correction in price a little bit. As people want to move, you'll start to see that happen. That prices will, they not necessarily fall. I mean, in certain locales, they will fall because they really are elevated relative to the average wage earner in that area. Um, but you'll see those prices kind of base out or stay static for a very, very long time. Because what happens is, and this happened since 2020, 2021, where we had all these incentives and all the easy money was flowing and yields were so low because, the pandemic and the pandemic relief efforts that the government did. It gave people a lot of wind in their sails in terms of buying homes. And that's what happened. Home prices accelerated far beyond what incomes did.
Mm-hmm.
Well, at a certain point, which is what you were mentioning, the income level has to come up or the price of the home has to come down. Okay. It's one or the other. And I think prices not necessarily will come down, but I think what they'll do is they'll stay static. And over time, average incomes will come up to make that more affordable. So instead of having the $400,000 home come down to $300,000, instead, the $100,000 of income will come up to $130,000 to $40,000 in income and make that math work. So it'll take time, but we went through a large leap in that marketplace, and it will slowly begin to normalize as people's wages will come up.
So the math has to be mathing, is what
Yeah,
what we're
for
saying.
sure. The mortgage companies uh, cannot do what they used to do in 2005 and 6 and 7, and just say, how much do you want to make? 300 grand. Fantastic. That's what we're putting down. And you don't have to prove it. So you can't do that anymore. And so,
Thankfully.
yeah, thankfully. So the proof is in the pudding, and people's income have to support that. There will be certain locales that you'll start to see um, people moving away from even faster, where earning $500,000 a year no longer affords you a decent lifestyle, which I know for listeners or to viewers in other locales where $100,000 is a lot of money and you can make a great life with it. If you take that $100,000, put yourself down in downtown LA, you're broke.
Yeah.
You can't afford to live without roommates. You can't, I mean, there's a lot of adjustment from cost of living between different places. Um, so I currently have a number of clients that are young professionals making as a couple over $500,000 a year in large metropolitan areas and cannot make a house purchase. So now
Mm.
they're looking to relocate. So they want to relocate to more affordable areas, perhaps make a little less money, but be able to afford more. So it's interesting to see that thought process and that financial planning process go through.
Yeah. Yeah. It's super interesting. And I'm definitely like paying, my ears are like totally perked up and like listening for, what's happening next with that. Because yeah, I think when you see, like you're saying, a couple that is making, in the top, 3 to 2% of incomes in the entire country that can't afford to buy a home where they live, that's pointing to a bigger correction that needs to be made in some way, right?
Yeah,
Whatever that looks like.
yeah,
So
in
if it
some
looks,
way. Yep.
yeah, if it looks like moving to a more affordable area, and really work from home, different things like that are still really prevalent right now, that might be what the answer is too. You have an internet connection, move away. One of my clients, her company is starting to implement, you have to be, from 100% work from home to you have to be in the office 3 days a week if you live within 50 miles of a location.
You're like, I'm
So
moving 51 miles away.
right? So that was what like, "Is there anywhere you wanna live that's, like, 55 miles from the office?" And she's like, "Okay, yeah, let's look around at that." It's that like, that big of a thing, right? That, um, just the way that work has shifted, that we could maybe potentially start to solve this problem in that way by just moving to more affordable areas.
Yeah, I agree. I mean, it's interesting because we've always talked about the labor market, particularly the last couple of years being so strong and those types of things. And now companies are trying to reverse that process a little bit. You mentioned 3 days a week. A lot of companies I know, both here in Utah and Arizona, a lot of the companies have said, "Hey, you need to be into work, Tuesday, Wednesday, Thursday. Monday and Friday, you can work from home, but we need you in for those 3 days." And the justification goes to culture. We're trying to build a culture. We're trying to build the relationships between our coworkers and our employees and managers so that everybody's on the same page. We're all pulling the rows, the oars in the same direction, so we're as efficient, as effective as possible. And I understand that rationale, um, but for future um, models, I think labor mobility is something that employees and employers must consider. Um, many, many years ago, we had a client and his wife worked for PNC Bank. She was the only bank employee in the state of Arizona for PNC Bank many years ago. And it's because she was able to get um, connected to their software system via the internet and was able to work. And her work didn't involve interacting with clients or too many people. But um, I think that's the way it's going. And I know a lot of large companies want to have people in house. I'm just not sure for small companies if that's a solution.
I my honest opinion is that I think the employers that pivot to full work from home and that's 100% okay and part of the process, those are the ones that will survive longer than the ones that are like, "Nope, we gotta make it work." No, people are voting with their feet, um, and,
Yeah,
leaving.
I think what you'll also see is there will be an income disparity. So the companies that require three days a week inside, you have to live in a certain area, right? To then get, so they're going to pay you a premium, or they're going to be forced to pay you a premium to have you live in that area and come into the office. Whereas companies that are fully, flexible labor mobility, flexible working arrangements, uh, probably will get away with paying less simply because of the fact that you can live in a lower cost area and no one cares. You can still do your job. The requirement is not, I've got to live in a high cost area and be in the office 3 to 5 days a week.
Yeah. Well, so we've been talking a little bit about housing bubble-ish, in this portion, and the other bubble that you wanted to talk about today, or bubbles in general, is really with regards to AI or artificial intelligence. So tell me what you have, been talking about this week,
Okay.
with advisors and the team.
Yeah. So one of the things I've heard a couple times in the past couple of months is the equity market's in a bubble or starting to go into a bubble, or AI is a bubble. Okay. And it's an interesting term, and there's a lot of things to that which I'm not sure most people understand. But Hyman Minsky is an economist who wrote a great book on bubbles. And there's different types of bubbles. There's credit bubbles, there's asset bubbles, there's stock bubbles. And what we're talking about right now is AI. Is it in a bubble? If it is, where are we in the bubble process? Are we at the beginning? Are we at the end? Where are we? And so I've gone over a couple of these. So there's 5 stages to a bubble, an asset bubble, 5. The first one is displacement, which means a new innovation or a new technology or a new product or service comes into being, and people start to realize it's displacing other services, right? So the great example is the internet, right? The internet displaced a lot of labor, right? Because now instead of having your secretary type out a letter and send it via the US post office, you can write an email yourself faster. It can already spell check and you're already done. So there was a lot of labor saving related to that. So displacement is that new technology, that new innovation. The second part of it is a boom, where all of a sudden people start getting on board with, hey, this technology is going to save us a lot of time, a lot of labor. It's going to make us more efficient and effective in doing our business and running our business. Fantastic. Well, all of a sudden, asset prices, investors start to go, oh, whoa, who are the companies that are going to make the money? And we're all going to participate. We're going to take a bite of that. We're going to start investing. And that's when those asset prices start to accelerate, those stocks. Back in the internet, if you wanted to have a billion-dollar company, all you had to do is put somename.com. Okay. And if you did, you didn't necessarily have to have a lot of revenue or earnings. You just had to have the name.com. Okay. And then you were off to the races. People would buy you because investors they had FOMO, they had fear of missing out, that they were there. So everybody was buying these internet stocks. Similarly, okay, AI, same thing's happening. Okay. It's in the boom. Right now, we're buying all of the chip stocks, the infrastructure builds. The second stage of that boom will be the applications of AI. And you're starting to see some of that. You're starting to see innovative companies taking AI and making it more effective in their business model. Okay. You see AI related tools, ChatGPT. You're starting to see specific applications using AI to better a business model. So that's the boom part. The third part is euphoria. And euphoria is to the point where it's like, this stock has such a wonderful outlook for the next 5 to 10 to 15 years of this technology that there's no way this thing's going to go down. There's no way we're going to lose money. So people start to buy it in increasing numbers and, importantly, start to leverage themselves to buy those investments.
Mm.
Okay, so that's a critical factor in there. So whether it's margin, whether, it's at one point, it's always been margin. It's been a home equity line of credit they tap. It's credit cards. It's somehow they're gaining leverage to buy these investments because the outlook is so wonderful. Well, during the boom cycle, the prices get to be far above any rational justification for value. Okay. And the way you start to notice it is analysts will come up with new ratios or new metrics to justify the current valuation or a higher valuation a year out. And oftentimes they're pretty unusual metrics. One of the ones in the internet was eyes. If you had eyes on your website, you didn't have to have much revenue, you didn't have to have much earnings, but if you had a lot of eyes on your website, you were going to be a billion-dollar company or more. So that was very euphoric. Okay. Now, euphorias can last a while. So it's one of the things that you don't want to cut yourself short in these times. But eventually, it's people start to go, okay, I'm going to start to sell a little bit, take some profits. The people that have been in the longest, like at the early part of the boom time that invested, that have held on, and they've made a significant amount of money on these investments. At some point, they start to say, okay, this is getting a little too crazy. I bought this thing for 100. Now it's 900. Maybe I start taking some off the table. And you start to see a tipping point. And that tipping point the price starts to fall, and it falls a little bit more. And then it rebounds to a higher value than it was in its prior peak. Then again, it starts to fall off a little bit, more. Then it continues to go down a little bit at a time. And then all of a sudden, we go into the fifth stage of a credit bubble, or of a bubble. The fifth stage is panic. And that is when all of a sudden everybody starts to hit the exit gates. Everybody starts to sell, and it accelerates, and that price of that stock comes back down to earth into a more reasonable range. Now, this has nothing to do with the underlying technology. For example, the NASDAQ 100 fell 75% in the early 2000s. Why? Because the internet stocks were too overvalued. Did the internet itself start to get used less during that time? No, it continued exponential growth in usage during the time that tech stocks went down 75% and took 13 to 14 years to get back to break even. So the underlying technology is valid. The underlying technology still grows at a rapid rate. But the problem is the value of those stocks are bid up to levels that are eye-watering.
So the 5 stages of a bubble, just to reiterate: 1, displacement; 2, boom; 3, euphoria; 4, profit taking; and then 5, panic.
Yep,
So
exactly.
that's our 5 stages. So when we're talking about AI in particular, before we started recording, you were sharing that you thought that it's for the most part, overall with AI, we're likely at the beginning of the boom stage with
Yes.
most stocks. So yeah, tell us a little bit more about that.
Okay. I think a few individual stocks may be in euphoric areas. Okay. But most of the stocks that are in the AI group are not. They're in the beginning of the boom.
Mm.
Right now, like I said a little bit earlier, right now we're in the infrastructure. Most of the benefit of AI have been from the chip makers, the people that make the actual physical chips, which run the software for generative AI. Okay, so that is the infrastructure. So they're usually the first beneficiaries. The second beneficiaries will be the applications. Who is using AI to create a service that sells to other companies or to other households? That's the next step. So let me give you an example. And the third step is the government starts to use it. Okay.
Mm.
Government and heavy industry. The first step right now, chip makers with AI, right? You've got NVIDIA, AMD, you have Broadcom, you have Micron, you have a lot of different chip companies doing quite well because they're the ones that make the hardware and the product that allows generative AI to function. Applications are the second part, and that's where we're starting to go into. You're going to see a lot of software developers use generative AI. The easiest example for everyone is a chatbot, right? That's a function of AI. AI, you get on, you ask a question, a frequently asked question on the website, that information, that software, that AI application will then tell you the most likely answer that you would like to hear. That's a real simple one, but it's going to go far, far, far beyond that. And we're just in the beginning stages of that, of the transitioning from the chip to the application. So
So
for the most stocks are still just in that boom stage.
so what happens to like the infrastructure pieces as we start to move through, to the application, then to the government and heavy industry usage? Um, do those initial pieces continue to ride the wave as they go up, just at like a slower pace, or what typically happens?
It depends on how they change their business model. If they just stick with the hardware, then yeah, they eventually kind of fall off because whether we like to know it or not, at some point, generative AI chips are going to be pretty easy to get, pretty inexpensive. Okay. They're going to become commoditized a little bit, much like semiconductors were for the internet. Excuse me. And so if they don't change their business model, they will kind of go by the wayside. However, if they convert and they change to become more offering applications, then they can really grow with in that next stage of boom. Um, and so it'll be interesting to see if the chip makers are able to keep up with this and continue to make pace. Right now, there's only a few chip makers that can make really good chips like that, and there's one in particular, NVIDIA, that makes the most.
Mhm.
So obviously, they're the biggest beneficiaries as of right now. Now, 2 to 3 years out, that it could be anybody's game. Right now, NVIDIA has a pretty good lead, but the other chip makers are for sure ramping up. And there's a lot of very, very well-moneyed chip makers that are going to try to take NVIDIA's business away from them a little bit. So again, that competition is very, very good and will drive prices down even more. And that will be helpful for the industry.
So we're talking about AI specifically right now, but you also mentioned that, you've heard a little bit or some people speculating that the market as a whole might be in a bubble, right? Because we've been seeing all-time highs again on the S&P 500, on the Nasdaq, all of that. We're seeing these again hitting maxes pretty often over the last month, right? We've seen it go up. Where do you think the the market as a whole is in that bubble cycle?
Market as a whole. So I'm going to separate the market right now. There is the top level, the top group, okay, the Mag 8, okay, which has driven the headline index to the highest level. Those stocks are not, they're expensive. All right. They just are. And that has caused the headline index to be at its all-time highs. Okay, maybe 1% off. I think right now we're down by 1% off the all-time high. But if you look at beyond that, if you look to the second tier, not even the second tier, just the next group down for large cap, um, you're off about 7% from your all-time high.
Mm.
Still, if you go down even further, mid cap and small cap, you're about 15 to 23, 24% off your all-time high. So there's a lot of companies that have not participated yet in this kind of boom or this bull market, if you will. So they've appreciated a little bit, but they're not even close to where they were a few years ago. So it's something to keep in mind when people come to me with cash and they say, hey, I want to invest. What should I do? I would say, look, if you're looking at the headline index, you're right, it's expensive. However, if you look at the second tier large cap, which are fantastic companies, which are growing, which are solid companies for the most part, a lot of them, you can pick those stocks and pick those companies and pick those areas which have good, decent look ahead earnings growth that may be warranting some investment. Excuse me. And that's what we've been seeing. An interesting dynamic to go on this point. Hold on just a second. I'm going to cough again.
Get it out.
Yeah, it's crazy. It's springtime, so allergies are here. Um, one of the things, and I'll talk about kind of a scenario, is a lot of tech stocks are at expensive rates. A lot of data centers are being built. Data centers use a lot of energy, lots of energy. And so utilities are having to up their production capability to generate more electricity so they can fund or they can supply these data centers with enough electricity. That is a serious that's going to have an impact. So the energy sector, which right now very inexpensive, you're going to have a lot of demand for natural gas and oil to generate enough electricity for data centers to exist. Same with cryptocurrency mining facilities. They are very, very energy intensive. They use a lot of energy, and as part of their part of their supply chain management is how can we get enough electricity cheap enough. And
Mhm.
so where they're locating their quote unquote mines, which is basically a data center, um, they have to be very cognizant of who's going to supply that energy to them, because you can't just shut down those computers.
Right. Oh, that's so interesting and such a good example of looking at investment from a more holistic lens too, right? So it's not just what companies are doing really well on the headline index, it's what is going to support those companies to continue to thrive. And those they're going to hopefully bring those um mm, collaborative, or what would the right word be for that? Those adjoining industries up with them.
Exactly, exactly. So it's an interesting time where I think that people that do style box investing, you know, the style box investing that Microsoft or Morningstar made very, very popular in the 80s and 90s and 2000s. I think, I think it's getting blended a lot. I think they're bleeding into each other a little bit, and we're going to go back to a more holistic way of investing. Um, at least that's my outlook for it.
Yeah. So just to elaborate on that a little bit here in this last minute, style box investing, meaning you have a certain percentage in large cap growth and a certain percentage in large cap value and a certain percentage in mid cap value and growth and small, and then international, right? So the style box being, your company fits neatly into this box because you are a large company with $50 billion a year, or $50 billion of market cap, and you pay a dividend. So you're a large cap value. Right. And so we want some of that in the portfolio versus looking more inside, maybe like more under the hood, even you could say, and looking more inside to what's what's performing well, whether that's large cap, mid cap, or small cap, and then what are the complementary stocks. Again, those adjoining um, symbiotic industries that are helping the current thriving space, and investing there instead.
Yeah, and that's really what it is. It's the symbiosis between two different companies, which may or may not be as evident if you just look at it on the surface. You know, if you have a utility company, their earnings may be growing pretty quickly because there's a bunch of data centers around there that they have to produce more electricity, therefore they make more money. So it's a good it's just a good train of thought to do analysis.
Mm, love that. So it's time to wrap up. This has been a fascinating conversation. I love it. And if anyone would love to hear more or have any questions around anything that we talked about today, as always, we welcome and invite your comments, your questions. Um, if you disagree, if you agree, whatever, like whatever's coming up for you, we'd love to hear it so that we can, talk about it and respond. The more that we share information, the more that we are open, I think it's better for the industry, for individual investors, everyone. Yeah, I think that's a big piece of my heart and big piece of wanting to do this podcast, just in general, is to be able to spread the wealth of information that we have in our little, I don't know. I guess we're kind of like a mastermind.
Yeah, yeah. And we would, again, just to reiterate your point, we would love to hear your questions, your comments, anything to help us make it better, to make it more engaging for you as a viewer or as a listener. We would absolutely love to hear anything you have to say.
And if you want to reach out to me, you can get me for the podcast at Hannah, Hannah, at expansiveceo.com. And Brad, how can people get a hold of you?
You can get a hold of me at at B Haines, Haines, at juncturewealth.com.
All right. Well, until next week, we hope you have an awesome week and we will see you next time. Thanks for being here with us, Brad.
Thank you.
That's it for this episode. Thanks for listening and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, Hannah, at expansiveceo.com and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough. You are enough. And your birthright in this lifetime is to be expansive.